learn the advanced financial management, we firstly need to understand the meaning of financial management. So, the very meaning of the financial management is putting the resources, ensuring the deployment and acquisition of resources in such a manner so that the overall objectives of an organization are achieved. Basically, under financial management, we are concerned with the circulation of money in an organization. So under financial management, we'll look into sources where money will come from, and then where it will be invested, where it will be put into. This is what the main objective of financial management is. We'll identify the sources, and then we'll see like where the money can be invested so that we get the maximum profitability. Right. So this is the meaning of the financial management. Now coming on to the importance, like why the financial management is important in any business organization. So I've taken a basic example of two Indian businessmen. So as we all know, when the Dhirubhai Ambani died, the family property was equally divided between both the brothers. So the money they got was of the equal amount. This is a classic example which provides you with the importance of financial management. Why do we need to learn financial management? Why do we need to ascertain what is the importance of the financial management? So as I've told you that the family property got divided equally between the brothers. But what happened? Some brother got one sector, the other brother got the leftover sectors. But then it was the vision and it was the management of the finances which enabled one of this brother to achieve milestones when we talk about their business policies and the strategies. And one brother was declared as a bankrupt. So this is what the very importance of financial management is. Financial management can bring a huge success to the business, or it can even lead to the failures of business. So this example provide you with the importance, like why financial management is necessary for any business organization. So even it is a small organization, the medium scale or a large organization, financial management is necessary for every sort of business organization, because it ensures that okay, like the finances are managed well. Because if the business finances are not managed well, then business can fail. It is very important that the business finances are managed well. So as we discussed that ultimately what we need to do is we need to have a knowledge of, we need to have a foundation of the financial management topics. Ultimately, advanced financial management is the advanced level of it. By advanced level, we mean that whatever the concept we have studied in financial management, we have done each and every concept. Advanced financial management just will introduce you with the 2-3 new concepts. All other concepts are taken from the financial management only. So whatever concepts you have studied in financial management, you will be applying it practically. In advanced financial management. So you will come across the case study scenario. You'll come across various case studies in advanced financial management. In most of the cases, they'll put you into the shoes of the financial manager. They'll provide you with a role of financial manager or a senior financial manager and give you a particular problem. They'll provide you with a particular case study and ask them to report it to the manager. So you will be put into the shoes of the senior financial manager or a manager. You will be given some of the problems, some of the case study, and you will be asked to prepare a report and present it to the manager of the company. Ask you to evaluate the problem, evaluate the scenario, and give your recommendations accordingly. So cash flow, as we know, it is cash inflow minus cash outflows. So what is the difference between cash flows and free cash flows is that the cash flow is just the net cash flows. It is the cash inflows minus cash outflow. Whereas free cash flow is that part of the cash flows which is available for reinvestment purposes. So it is that part of cash flows which is reinvested, which is not retained in the business. So cash flows which will be distributed to the finance providers, which will be distributed to the equity, to the debt holders of the company. That is what the cash flow means. So cash flow is the amount which is available for the distribution to the debt providers. Now coming on to the investment appraisal options. So most of the options we have done, but you need to remember all the previous methods. So first method we have is ROCE. So ROCE is the first method, the basic method for investment appraisal, the very simplest method. ROCE used to take the relationship between the profits and the capital expenditure to evaluate your capital related expenditure. So the formula for ROCE was profits before interest and tax over initial investment. Then we did the payback method. In payback method, we used to say that it helps you to calculate the time period like within which you will be able to recover your cash flow. So we used to say in case of when we have even cash flows and when we have uneven cash flows. So in case of even cash flows, the payback period will be initial investment divided by annual cash flows. Whereas in case of uneven cash flows, we need to take into account the number of years taken for the project related expenditure to get recovered. So this is what the payback period means. So both of these methods are the simple methods for investment appraisal. And these are used for initial screening of your devices, initial screening of your projects. So we need to remember the advantages and disadvantages associated with all the basic methods as well. So an advantage will say that ROC and payback, these are the basic methods and these helps in the initial screening of devices. And for payback, we can further write down the advantages that payback is ensures liquidity, it minimizes the risk. And then the other advantage we had was that payback period ensures changes in technologies and change in production plan. Then we had disadvantages. Disadvantages, we used to say that both method do not take into account the time value of money. It used not to take into account the complete project life. And it does not give an absolute decision whether to accept the project or not. Then we had NPV. In NPV, we used to calculate the profitability with regard to project, and it provided us with a particular decision rule. So NPV was calculated by using formula. The profitability was calculated by taking the sum of cash inflows and subtracting it with the outflows. This was how the profits or the NPV was calculated.